A major bank is failing. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, a major overseas bank is facing insolvency and outright failure as a liquidity crisis is now flowing overseas. And this is a bank that we've talked about on the show before. We've said they had major problems, and I want you to see how the executives, just like with Silicon Valley Bank, are in complete denial and saying everything's okay. And yet I'm going to show you why this mega bank, this huge European bank, can actually fail. Plus, we've got some more information that shows the regional banks are in big trouble and that this problem that the government is trying to solve is not done and nowhere close to being done. Plus, we've got some data that shows inflation is coming down in a big way. And what I want you to see is how the media is calling this quote unquote unexpected. But those who watch the show knew that we called this a long time ago, and we knew this data was going to come crashing down. Let's over to Bloomberg, where we picked today's story up with a headline. Credit Suisse chair says Silicon Valley bank crisis looks contained and rejects talks of government assistance. And yet we know what that means is sooner than later, Credit Suisse is going to need government assistance along with a whole lot of other banks, because one of the problems we're seeing here with Credit Suisse, and we'll get into why they're saying it, is they don't understand the real problem. And this is a big confidence game with depositors and consumers. They're starting to get worried, and in a big way that they're going to one day find out that their bank is gone under and their money may be gone, or at least now they have to wait in line to get it from the government. The contagion effect from the recent collapse of Silicon Valley Bank is local, they're saying, as Credit Suisse chairman Axel Lehman said on Wednesday, and he also declined to comment on whether his firm would need any sort of government assistance. It goes on to say when he was asked by CNBC if he would rule out some kind of government assistance in the future, Lehman answered, "That's not the topic." Of course, we know that perhaps now, only in a matter of weeks, that he's going to actually say, hey, we need some government assistance, because we're going to make the case why Credit Suisse is in dire shape, why the confidence in them as depositors are going to see is actually very low, and money is going to go fleeing out of a whole lot of banks, including this big one. We're regulated, he says. We have strong capital ratios, very strong balance sheet. We're all hands on deck, so that's not the topic whatsoever. And he says, I looked at what happened in Silicon Valley Bank and subsequently other mid-sized banks, and he's saying, look, this is a regulation issue. They're not subject to the same regulations we are around other parts of the world. As he mentioned, the Basel III requirements, we talked about this or touched on this in the show the other day, that underpins most banks' operating framework. So he says in this regard, the contagion is somewhat local and contained. But he notes that Silicon Valley's fallout serves as a warning signal for the overall market. And so what he's seeing here is, hey, this is just a regulatory issue. We've got plenty of money. It doesn't matter about that. And what I'm trying to explain here is he doesn't get it. This is a confidence game, and there's things about Credit Suisse that are coming out that are downright ugly. And at some point, depositors are going to start to wonder, is this bank going to stay in place even though they're a huge bank? And that's why I see at some point they're going to turn and grab government assistance, because they're going to need it in a big way. And one of the reasons we're seeing this is just strictly deposit outflow. Again, a lack of confidence. Let's take a look at this article here. As BofA gets more than $15 billion in deposits after Silicon Valley Bank fails. In Silicon Valley Bank's seizure Friday, the biggest bank failure since the financial crisis, was precipitated by fleeing depositors and sent shockwaves across the global financial system. It forced the Biden administration to put into place extraordinary new measures to fortify faith in the banking system, which I said wouldn't work, and so far aren't. And in last week, crypto-focused bank Silvergate Capital closed shop, and authorities shut down New York-based Signature Bank on Sunday. And so what we're seeing here is what Credit Suisse doesn't get, is that consumers, depositors right now are concerned. They're wondering, is the money at my bank safe? And if they're not certain, they're opening accounts elsewhere, or they're looking on how to move that. And if they start to see signs that something that we'll look at later is that says that Credit Suisse Suisse has got big problems, well, you can bet they're going to see it too. And one of the reasons, of course, we noted about the regional banks seeing stress here is because what did I tell you? That there would be a policy response. Well, we got two of them. We got one from the Biden administration, effectively guaranteeing deposits everywhere. Not a problem. Don't worry. Forget that FDIC limit. We got your back. The Fed steps in and says, hey, don't worry, banks, we'll lend you money. We talked about the Federal Home Loan Bank borrowing a bunch of money so it can provide liquidity to these small banks. And what are we still seeing? Deposit outflow. And that's the big issue, is depositors and consumers do not believe any of this is going to work. And that's why I said the first round that they would try to save this, the first response wouldn't work at all. And now let's look deeper into why Credit Suisse has got big problems, is going to see deposits flow out in a big way. Credit Suisse, this going back yesterday, finds material weakness in financial reporting. Whoopsie, we'll say, as it had to delay its annual report last week because of last-minute questions from the U.S. Securities and Exchange Commission around some earlier cash flow statements, which the bank had revised in its 2021 annual report for the prior 2 years. The bank said this annual report that those revisions were a result of the weakness it had found, and that there could be, well, more material misstatements. Now, you see, again, we come back to a confidence game here, and if you will have deposits at Credit Suisse and you start to see this, are you starting to wonder that, hey, maybe there's some other problems underneath there? Well, for Credit Suisse, it gets a whole lot worse, but if only there was one way to see this coming, and there was. As our CTA-Timer Pro report told you to get out of the equity market or cash in your gains quite a while ago. You know, over the last few weeks, we've been covering this, and now it's telling you, look, the machines are looking to move long on their fast algorithm. The slower ones are covering shorts, moving long soon, and it's all telling you exactly what you need to know to be positioned. And of course, this report, a mere $30, comes with a 30-day money-back guarantee. Link in the description below, because now there's another sign. If you think the accounting issue with Credit Suisse is an issue, it's not. That's just the beginning of a whole lot of other problems they're about to face. As Credit Suisse in fight to win back confidence, there we go, there's that word confidence, as shares plunge. The Swiss bank stock plunged to the lowest level on record, and its credit spread surged as the company's top shareholder ruled out increasing its stake because of regulatory constraints. We're going to get to that here in a moment. That helped drag all European banks lower as investors show a quick trigger on shying away from risk after the turmoil of past weeks. So right now, what do we see is happening? The U.S. government effectively is stepping in and guaranteeing deposits. But what did President Biden say? Hey, look, I don't care if the shareholders get wiped out. I don't care if the bondholders get wiped out. It's called capitalism. You took the risk. You're at fault. I just care about deposits and making sure our banking system is solvent. So if you're a depositor and you see your stock in your bank crashing, or in the case of Credit Suisse, maybe becoming a penny stock, as we'll see on this chart here, going from a high of a little over $79 a share, and this morning was down almost 98% from its all-time highs, trading just like a penny stock. So if you think about that and you wonder, hey, what happens maybe if the stock keeps falling and the bank becomes insolvent? They have to sell more stock, just like Silicon Valley. Maybe they can't. They start to fail, and you wonder about your money. And that's why we see on this piece here that Credit Suisse said they couldn't get some more money because they couldn't get their big top shareholder to give them some more. Well, let's talk about that, because Kroner on Tuesday pointed to the firm's liquidity coverage ratio, as I said before, which indicates the bank can handle more than a month of heavy outflows, but yet they did see some inflows on Monday. The question is, how long will that last? Because if your biggest shareholder, who you would hope would give you money, can't because of regulatory constraints, and I want to set this up for you, because why are they even commenting about this in the news? Because who do you think Credit Suisse picked up the phone and called, or maybe got on the plane to visit and says, hey, we need money? And when you start to see a stock price crashing, you start to see misstatements in annual reports and maybe other misrepresentations, and you start to wonder, is your money safe? And then this bomb drops on Credit Suisse right after all of that. Credit Suisse bonds plummet to distressed levels in New York as things just keep getting worse for this big bank. And several other Credit Suisse bonds plunged by more than 10 cents on the dollar Wednesday, leading to declines in New York credit trading, with spreads flirting above 1,000 basis points. And because we talked about in the show yesterday, when credit spreads widen and rise, it means there's stress in the system. And bonds trading with a spread of more than 1,000 basis points over government debt are viewed as distressed by the credit markets. And as a result, the cost of insuring Credit Suisse debt against default in the near-term hit a level signaled serious investor concern. So not only bonds are in trouble, but check this out, because what you can see, the cost to insure them against default in the near term approach a level typically signaling serious investor concerns. The bank's senior bonds led losses in Europe's high-grade corporate bond market, slumping between 2.5 and 5 cents on the euro. And of course, its deeply subordinated additional Tier 1 notes are all indicated well below 80% of face value, a level associated with distress. So if you, again, are a depositor there or think about moving money there, and you're saying, wait a minute, you've got all these regulatory problems in your finances, your books are cooked effectively, your stock price is trading like a penny stock, the bond market says you're going to likely default, the cost to insure these things is pricing in a default, and you start to wonder, is your money good, and how soon will Credit Suisse be running to the government for a bailout because their biggest shareholder said no? Now let's talk about the Fed, because we've got a meeting coming next week. We have some data that says, again, the Fed is wrong, but we said this would happen. But I want you to see, again, this is how the media spins this stuff, and they've got it completely wrong. Wholesale prices post unexpected decline of 0.1% in February, and we'll get to retail sales another day. The producer price index fell. Wait, it actually fell? 0.1% for the month. Hey, they said this wasn't going to happen. Experts said it should have go up 0.3%. On a 12-month basis, the index increased 4.6%, well below the downwardly revised 5.7% level from the previous month, which means it actually decelerated. Excluding food, energy, and trade, the index rose 0.2%, down from the 0.5% gain in January. And on an annual basis, that reading was up 4.4%, or slowed to 4.4%, the same as in January. Excluding food and energy, the PPI was flat. So wait a minute, what that's telling us is the market doesn't believe it. The experts said this wasn't supposed to happen, but when you see this next chart, which we've shown this show before, the real issue here is that producer prices are highly correlated to energy, highly correlated to crude oil prices. And when you realize that, you knew ahead of time that producer prices were likely coming down, and get this, are going to head down even more. As we can see on this chart, we have the producer price index by commodity, with final demand showed on a year-over-year basis against crude oil prices. West Texas Intermediate, that in red, both on a year-over-year rate of change. Notice the nice relationship between these two, with crude oil prices leading producer prices down most of the time. And here we can see crude oil prices saying, hey, look, you're on the PPI, you're coming down again and again. So now we know, look, things at Credit Suisse are getting bad, getting worse. We know the regional banks are going to see more outflows as more news scares them into pulling their deposits. The government's backstops here, the Fed's backstops, completely ineffective. We saw the CPI report suggest the Fed could hike next week, but producer prices are saying, wait a minute, you better check yourself. Inflation is coming down, and maybe we'll even see deflation. More bad news for the banks. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.